Happy New Year from ADK Wealth Advisory Group's office in St. Louis. Today is our 2020 market update, focusing in on looking back at 2019 and looking forward to 2020. If I were going to summarize 2019, it would be slowing growth, but growth, slowing in both respects to GDP as well as corporate earnings. Would also be fraught with a lot of global uncertainty regarding trade systems. And then lastly, it would be unexpected excellent returns, and the breadth of asset class return was pretty unprecedented. So let's take a look at some key factors when we look back. Number one is really around an article that the Wall Street Journal posted recently, and they said that GDP growth globally had slowed in 2019 to 2.3%, so still growing, but at a pretty low rate, and it was down from 3% in the previous year. Some bright spots: the U.S. economy. Some areas that tinkered on recession but didn't fall in would be South Korea. They had a lot of trade tensions with Japan. And Germany. South Korea and Germany both obviously are very heavy export countries. When we look at some other key factors, it's really the trade tensions between the U.S. and China, Brexit. And all in all, you could really say that free trade has never been completely free, but it's created a system that everyone knew supply chains, and it was somewhat organized and unified. And what's going on right now is that's all resetting. It's going to be resetting, in my view, for quite some time. When I take a look at what does that result in, so if you can imagine all of these supply chains that have been like this that are now creating a lot of uncertainty, CEOs don't really know how to invest for the long term without it being something that maybe isn't possible 5 years from now. And if you compound that with the concerns of us sliding into a recession, which has been a nagging concern for corporate CEOs for the last couple of years, all in all, you've seen just a pullback in corporate spending, which again hurts global GDP. When I look at financial markets, again, having done this for 30 years, last year was a very unique year. I can only remember 1 year in the 3 decades that I've served clients that we've seen rates of returns like we saw across asset classes. So for example, you take a look at the bright spot with the U.S. equity markets, really excelled, but literally emerging markets made money, developed world ex-U.S. made money. Real estate and gold made money. If you look at bonds, the safer bonds made mid-single-digit returns, and then the riskier bonds, whether you're talking high-yield junk bonds or emerging market debt, all did low single digits. Now, the biggest concern that people have when I'm getting questions is, with that kind of return, is the market overheated? If you take a look at it, equities really make money in 2 fashions. One is through corporate earnings, and the second is PE expansion. If you take a look at PE expansion, it's really talking about, is the market overvalued? LPL's research team provided me with the Bloomberg's data showing the historic S&P 500 PE, which averages 17. If you look at forward PE for 2020, and that would be current market price in projected earnings, the PE is like 18.5. So it's at a slight premium, but certainly not what I would classify as excessive. As we look forward to 2020, the 2 main questions that I hear from you, our customers, one is, when will this historic economic expansion end in a recession? And 2 is, how will the financial markets and when will they start to pull back or respond to that? On the note of recession, we use gauges that have a macro dashboard that look at a variety of economic indicators. None of these are conclusive because they provide data. You do the research, but you can never really know for sure. But it's our researched opinion from these dashboards that the likelihood of a recession in the first half of 2020 is close to zero, and it's very unlikely throughout 2020 at large. Now, one of the key things gauge-wise is this concept called an inverted yield curve. Typically, a yield curve, when you're talking about interest rates, inverts. So the short term is lower than the long term. Now, an inverted yield curve basically means that the short end, it spikes up above the long end, so it inverts. That occurred in September of 2019, received a lot of headline news. And candidly, it is a gauge that when it inverts, there's a high statistical correlation to a recession following. And that was what the headlines were all about. But I didn't see any headline that talked about how long is the average from the time that inversion occurs to when a recession happens. And historically, it's 18 to 22 months. So you're talking, call it a year and a half to 2 years. Now, the variance is large, so it could be sooner, could be longer, but that's why you use a dashboard with multiple gauges and don't rely on just one. Some risks that are really real. One would be the global central banks if they over-tighten. Now, I had some concerns that the Fed was doing that in 2018, but they really responded in 19 with 3 different moves where they lowered interest rates. And across the board, whether you look at the central bank in the US, the UK, Europe, Japan, China, all of them are either at status quo or loosening. So none at this particular stage that are significant or tightening. U.S.-China trade relations, as I alluded to earlier, that's going to be something that is disruptive to these supply chains for an extended period of time. If the phase 1 is signed in the first half, it takes away a headwind. I don't think it's a real strong tailwind, but it helps because it's not hurting. And when I take a look at things like wild cards, Iran, you just really don't know how the U.S., Iran, Middle East, how all of that will play out. Our base case scenario is that it creates a lot of headline news that's geopolitical risk, but on the economic front, really not a lot. Why do I believe that? Historically, when you've had Middle East tension, you've seen a stock price for futures skyrocket for oil. So last year, for example, when Saudi Arabia was attacked and a lot of their supply was reduced because their production was hit, historically that would have probably caused oil to spike up a lot, maybe even cross over 100 a barrel. If you take a look at what really happened, not much in the price of oil. Why? It's because the U.S. is now the global swing producer. Through fracking, we were able to turn on the spigot, meet the global demand, so supply was cut from the Middle East, but not globally. It's our belief that if supply gets crunched from the Iran tension, that the U.S. will be able to meet that. You always have the wild card issue that you just don't know, will bombs end up getting hit towards Israel retaliate or even take a preemptive strike and have a complete meltdown in the Middle East. If that occurs, I don't believe that it will, but if it does, I believe that the markets will respond negatively to that. But as long as corporate earnings are there, as long as global GDP is positive, I think it would be short-lived. The last is really 2020 is an election year. So election years always create volatility in the second half of the year. Always is too strong, but creates a lot of volatility, and more often than not, it's towards the back half of the year. In conclusion, the 2020 timeframe, really what we're checking out is a recession. Likelihood to me is very low on that. We'll be monitoring global GDP, U.S. GDP, corporate earnings, and valuations, but candidly that's a little bit more because of what we're looking for in 2021. Election is another issue we talked about earlier. I get a lot of questions around what will the election do to the financial markets. I don't think the election does anything to GDP, but it does create a headwind for financial markets. If I were going to say through my crystal ball, which we all know does not exist, what do I expect? I expect the first half of the year to have good returns across the board, but I would not expect them to even resemble 2019. I would expect that the summer months to the election increased risk of volatility. And historically, no matter who wins, red or blue, the markets end up responding very well. I would say that if Bloomberg, Trump, or Biden win, I would think that that historic norm would be there. If a wild card victory happened from, say, Warren or Sanders, I think the markets would have some negative pullback concerns about how they're going to be taxing things. So thank you very much for taking the time today to join us from ADK in St. Louis. I want to wish you a very healthy and happy 2020. If it's appropriate, we appreciate you sending this out to people that you think might have an interest in being clients of ADK Wealth Advisory Group. We've talked about wanting to have like 5 or 6 new clients each calendar year from referrals from existing clients. When that's appropriate, we appreciate it. Thank you for your trust. Thank you for your business.